Now, in terms of demand, exports, again, I think it looks like, exports this year is slightly going to be slower because, like I mentioned earlier, economic growth is starting to decline. Some of the major countries like China starting to slow down their purchase. So really, I think as economy is entering into possible recession, soybean and corn exports will also take an impact. So with this in mind, I think with this sentiment that's in the ground, you really can form a conclusion that, going forward, the picture doesn't look that rosy anymore, and any rally that we see in the market might not sustain as compared to early part of this year. Now, whenever we talk about demand for commodities, we always look at China. If China is slowing down, technically, I think pretty much your price of commodities will start to decrease, because China is a major buyer for a lot of major commodities. You just look at palm oil, they are the largest. You just look at corn and soybean, they are also the largest buyer of US corn and soybean. Again, I think this is fueled by population. China's population is large, and obviously they have middle income that's growing, so therefore they need a lot of grains. Now, China in the beginning of the decade, they were actually quite a big player in the soybean market and even the corn market. In fact, you look at back in early 1990s, China itself is actually a net exporter. In fact, they were pretty much exporting corn to some of the nearby regions. But that has changed since 2000. As population grow, as economy gets bigger, and really I think the population has also changed their diet. So in a way, I think from then on, we see that China is actually being a strong net importer for a lot of this US corn and soybean. But I think this time around, in this year, I think things are starting to look different, because China really showing you sign of slowing down. As you know, China is maintaining zero COVID policy, which means that if they recorded any case, whether it's only one case in a certain region or city, pretty much the whole city is under lockdown. And lockdown usually impact demand. So I think that's a key concern, because if China is facing slowdown, I think commodity prices will have an impact. Now, weather is something that is very unpredictable, and nowadays it gets very volatile. Now I'm not going to propagate whether the debate on whether climate change is evident or not evident, but what is more evident is that the pattern of weather patterns has actually changed dramatically. We see flood more often nowadays in some of major cities. So it doesn't mean that developed economy, they don't suffer all this weather impact. They do, and all this will have an impact in terms of your crop. Especially if you're planting corn or soybean, if you have a bad weather situation, a dry weather situation, normally that will have an impact on your production. So really I think weather is going to have a major impact going forward, and it's something that you have to pay attention to, not in a short-term basis, but at least on a medium-term or longer-term picture. Now, I'm just going to touch a little bit on Ukraine, because keep in mind, I think Ukraine and Russia conflict is still ongoing. Why is this important? Because if you just look at Ukraine itself, it's a country which actually export a lot of commodities. So if you just look at Ukraine itself, the composition, so Ukraine is actually a very big player in the sunflower oil market, the wheat, as well as corn. Barley, is to a certain extent they are very large. But I think what's important for us is the corn and the wheat market. So if you notice that when Russia put an onslaught of war on Ukraine, you notice that wheat actually limit up for 3 consecutive days. So I think that tells you why Ukraine is actually quite a big player in the wheat market. So obviously, if you are trading the wheat market, you have to be very careful on any development with the Russian-Ukraine conflict. If you notice, just a couple of days back, just over the weekend last week, we saw the report that Ukraine and Russia finally make an agreement to export some of the Ukraine wheat out to the overseas market. But just Monday this week, just a couple of days back, Russia actually struck one of the important port in Ukraine, and that actually caused a delay in shipping out wheat. So you saw wheat prices on CME actually rallied to more than 5%. I think that shows you how the Ukraine and Russia conflict, the development in the Ukraine and Russia conflict is going to impact prices if you are trading the grains market. Now, if you just look at crude oil, what I have here is comparing crude oil prices and corn and soybean. You notice that there's a very strong positive relationship, which means whenever you have whenever a high crude oil price, normally you expect corn and soybean to be high as well. So if you look at it, I think crude oil is quite well supported. So as long as crude oil stays above $100 per barrel, I think it gives a bit of support for corn and soybean prices. So that's something for us to take note. If you are trading the complex, looking at crude oil can help you to understand a slightly better picture on how corn and soybean will perform. So I'm not going to touch too much on China again, but again, I think China is an important player in the commodity space, especially when it comes to the demand. And not only that, besides China being a major buyer, China also, in a way, is a big player in the fertilizer market. We have seen the news just a couple of months back. China actually restrict the export of fertilizer because there's suddenly a shortage because of the Ukraine and Russia conflict. So really, I think China is controlling the fertilizer market in such a big way. And as long as supply chain is affected, and the Ukraine and Russia conflict doesn't resolve, I think this is going to be a big issue going into the medium term, because as long as China is not exporting fertilizer, some of the key planting countries will have a problem, because without fertilizer, normally you expect lower production, or you can't even plant at all. So I think this is something to watch out for in terms of news. But I believe that this is going to have a greater impact in the longer term picture, not in the immediate term, but more towards the longer term perspective. Now, since we talk about crude oil and the relevance of crude oil in terms of grains market, if you just look at it, whenever a high crude oil price, normally it relates back to biofuel. Now, corn and soybean are the major ingredient for biofuel. And whenever we have high oil price environment, as what you're seeing right now, normally people expect, corn and soybean will be used to blend with crude oil. But again, I think that's not the case, because you just look at it, there's a lot of demand for corn and soybean in terms of food. And I think some of these planters or farmers, they will rather produce to feed consumption rather than to blend with crude oil, because despite you see high oil price environment, the problem of the market is there's not enough supply to meet the demand, and that's going to be a problem. And this again will create food security issue. So obviously, I think this is something that we have to take note. But like I mentioned, I think you have high crude oil price environment, normally it is supportive for prices. So I think that brings us to the food and fuel debate. So we have seen how palm oil price or even soybean oil price has rallied, and I think that's putting pressure on some of the biofuel producers, because now to blend palm oil and soybean oil with crude oil is not cheap anymore, because palm oil has rallied to above 4,000 ringgit per ton. Soybean oil is doing about 50 cents per bushel. They are no longer cheap as compared to last time. So really, I think it is a matter of is there an incentive to actually blend vegetable oil with crude oil in the first place? But nevertheless, I think I think the close relationship that we can infer or we can conclude from here is that as long as you have high oil price environment, normally you see support in the grain prices. So that's pretty much the fundamental picture. So obviously, as a trader, it's good to have a fundamental perspective, because that will tell you whether the market is it going more on the optimistic side, or is it more on the bearish sentiment side. Now, besides looking into fundamental like reports, demand and supply, news, there's another key thing that is worth to pay attention to, especially if you are trading the grains market. One of the key report that we always look at, it's on a weekly basis, is what we call a commitment of traders report. Now, CME Exchange is very transparent in a way that they will tell you how much of the players in the market, whether it's an institutional, whether it's a normal retailer like you and me, whether are they holding long or short position in the market. Now, why is this report important? If you just understand this, if you have the report indicates that the overall market is holding a long position and it's net long, that tells you that the market is quite bullish. And vice versa, if the market generally everyone is holding short position, that tells you market is net short, and generally the market participant is expecting the market to come down. Now, what's important is that the net short and net long is the increase or the change on a weekly basis. So if you just look at corn and soybean report by the COT report itself, you notice that the net long position is actually starting to decline for both corn and soybean. What this tells you? Basically, this tells you that I think generally the market participant is expecting market will slightly be more bearish going forward. As a result, those who have long the market, they either come out from the market, or those who have long has actually turned into short position. That's why the net long position is starting to decline. It's worth to pay close attention to, because this report will tell you what's the sentiment on the ground. Is it really that bearish or bullish? So that will help you paint a better picture, as to where market participants are expecting market to behave in the next couple of weeks or months. Now, I'm not going to confuse you too much, or not going to go too deep into technical or understanding forward curve, but just to keep it simple, if you compare all the prices on CME exchange for corn, taking example, if you take a price of each of the month, you notice that there's a curve, and you notice the front contracts are actually trading at the higher prices. Why is this so? Because if current contracts or near month contracts are trading higher than further month contracts, it tells you that the market is still quite tight. People are willing to pay higher price right now compared to 1 month later, because they need it. They need the corn, they need the soybean now. But if you see or you notice that the price right now is slightly lower compared to 1 month later, that means generally the market is oversupplied. So this is what we always term as backwardation and contango. Again, I'm not going to convince you too much on this, but what's important is that you have to take note of the change in the structure. If you notice that all the while the front month contracts are trading higher than the far month contracts, then suddenly the front month contract starts to decline and it starts to trade lower than the far month contract. That means the structure has changed, and basically the sentiment of the market has also changed. So if you notice, I think just early part of this year, I think pretty much around February or March, the market is actually very deep backwardation. That means the front month is trading very high compared to the further month. But that has changed. I think just couple of early this month, we saw the structure change from very big premium to a very steep discount. In fact, I think some of the contracts in the near month is trading at a discount compared to far month prices. So again, I think this again tells you the sentiment. Not so much whether the market is contango or backwardation. It's more of telling you, how the market participants are expecting prices going forward. So again, I think as a trader, it's important for us to be aware of the sentiment of the market. Whether are the market participants be bearish or bullish in a sense. So what we are seeing now in terms of the prices for at least the next couple of months is that people are expecting the supply in the immediate term is quite a lot. So in a sense, that's why prices are lower, trading lower than the further month prices. So that's structure. Now, seasonality, again, I highlighted at the beginning, it's important for us to look at seasonality. If you are trading commodities, one good thing about commodities is that it always has a pattern. It always has a cycle. If you are trading palm oil, if you are trading palm oil, for example, or versa, you notice that year-end December is usually strong period. Now, what I have here is basically the corn seasonality. If you compare January to December for the past, I think 20 over years, you notice that normally for corn, December is really a strong period. Now, I mentioned early part in the webinar that June to August or June to September is quite a bearish period. And true enough, if you look at this table and you notice that the month of July, out of 20 years, you notice that there's at least more than 10 years or pretty much more than 50% of the time, that July will end the month negatively. So we are only just 1 day away from end of July, and whether to see, will we see that kind of historical pattern to repeat itself? Again, August is still quite a bad period for corn. So again, this July and August period is quite a bearish period for corn in terms of historical prices. So, as a trader, you can use this data as a relevance for you to paint your picture as to how to see the market. So same goes for soybean. I think July to September is usually the period where we tend to see prices tend to be trading more on the bearish side, more on the negative side. Now, since we are on the topic of soybean, I think it's important for us to talk about soybean oil and with the close substitute of palm oil. So I believe Indonesia and Malaysia, they are very big players in the palm oil market. So a lot of those traders who are trading the palm oil market will always look into the soybean oil perspective. Reason being is because if you are trading soybean oil, you notice that there's a close relationship between soybean oil and palm oil. So whenever soybean oil increases in value, you also see the similar effect with palm oil. Now, in the market, there is always a spread between the soybean oil to palm oil, and the spread is always, it's not to say always, but at most time it's trading at a premium. Because soybean oil, the cost of producing it, there's a lot of factors to why we attribute soybean oil at a premium, but naturally, I think historically speaking, soybean oil trades at a premium compared to palm oil. Now, this premium, the average is about $150. If you notice, I think just early part, or rather, I think late last year or second half of last year, we noticed that the spread has actually went as high as $600. That tells you soybean oil is way overvalued compared to palm oil, or rather palm oil is very cheap at that time. Now, normally this kind of extreme value, it will not last. And true enough, I think it took about 6 months. It went from $600, it went all the way down to quite close to zero, which means that there's no premium or discount between soybean oil and palm oil. Again, I think if you are someone that trade on this kind of extreme, it's worth to look at whenever soybean oil and palm oil spread goes to as high as $500 or $600, because that's where it's actually quite extreme value. So right now it's trading about $450 to $500. It also again tells you that soybean oil looks to be quite more expensive compared to palm oil. I'm not saying palm oil is, again, there's opportunity or being very cheap here, but it tells you that soybean oil is also not as cheap as what people think it is. In fact, there's more downside to soybean oil as compared to palm. So eventually this spread, which I show to you here, will probably be narrow going forward. Now, soybean oil, the fundamentals are also looking quite okay in a sense, because really you look at stocks level, they are still very low. And stock to usage ratio, if you have a low stock to usage ratio, that tells you generally the market is quite bullish. But I think going forward, stocks are actually going to increase, and because production is coming in, really is going to see is we have high stock to usage ratio. I think that's going to be a problem in terms of prices.